Hey, it's Soleil, and this is episode 111 of the Orange Pill Investor. And today I'm going to talk about two things, a little bit of MicroStrategy post-earnings follow-up on the pre-earnings trades that I made. And the TLDR version is they got wrecked. The $2,000 in out of the money calls did what I expected. I mean, I was hoping that the price of MicroStrategy would hold steady. That way, I could actually compare IV Crush and show how much the value of this account, or excuse me, of this trade was going to go down just from IV Crush alone. But the price dropped out. The bottom dropped out of MicroStrategy, and so I could probably sell the call for like $200. So it went from $2,000 to 200. Now, of course, I said that it was a bad idea to buy options before earnings anyway. But of course, I was secretly hoping that I would be wrong and that this, the MicroStrategy would pump to 2,000 or something, and then I'd make a metric ass ton of money on this. But not financial advice, but buying options before earnings is almost always a bad idea. So you can get, like, if we just go and look at MicroStrategy calls now, all of the calls that you could get, I mean, the price dropped $200. So this doesn't have, I can't pin this all on earnings. But if I remember correctly, yeah, so Vega at the money, I can bring this over. Vega at the money at 1260 call was 2.6. Now Vega at the money is 0.38. I can't say that that's all from earnings. The price did drop on this $200. But you can just look at the prices. So you can get all of these options that you could get yesterday are 80% cheaper, which really most of that is because MicroStrategy shit the bed. But yeah, so the trade went to shit, and I was able to actually pick up a few more cheap shares today. And what I was considering doing is, if you take a look at, I only trade shares basically in this account, and then I sell covered calls against it. But in my IRA, I actually don't have enough money to buy 100 shares. I used to when it was like 500 a share, but I kind of screwed myself, and the covered calls got away from me, and I actually ended up having to let my shares get called away, and so I missed out on a ton of upside. However, I just formed a poor man's covered call instead, and I should have put my covered call back on today, but I did not. No big deal. I can put it back on tomorrow. And yeah, the value of this really went to hell too, because now my covered call for January is at the money. That is unfortunate. The IRA really doesn't matter. I don't need the money. I'm not going to be able to access the money for quite a while anyway. So whatever happens in here can just happen. But what I was considering was doing something in my main account like I have in this IRA and buying like a leaps. So maybe going out here, and instead of buying something, this used to be in the money, but come down here to something at least 0.7, maybe closer to 0.8 delta, so maybe like right here. Buying a like a 700 strike for 54,000, but because of the way that margin works, if I sold 100 shares, it would only free up like 59 grand worth of buying power. So I would only be saving 5,000 in buying power and forming this synthetic stock, and it just wasn't worth it to me. So ended up deciding not to do that. But that's the quick update. I think with MicroStrategy, people were saying, oh, there was uncertainty about some kind of tax court case that they're ruling on, so maybe they just wanted to just sit on their hands and wait to see what the tax ruling is going to be before they decide how to report earnings, and I guess maybe that's smart. And the only thing that I was thinking about is that Saylor has been pretty good about making decisions that benefit the shareholders. Even from the very beginning, when he was like, okay, we're sitting on all these hundreds of millions of dollars of cash that's being devoured by inflation, and he's like, what do we do? Do we just do a dividend or stock buybacks and try to pump some value for the shareholders that way, and just let the company die slowly over time? Or what do we do? And he came up with a solution that benefited the shareholders. So if I assume that he is continuing to act in the best interest of the shareholders, then somehow, some way, not reporting FASB, he's imagining that this would, instead of sending it to God Candle and getting a double or something overnight and wrecking the shorts now, maybe he's anticipating the short interest just building and building and building, and he'll get more bang for his buck when he does report FASB. And maybe he'll be able to wreck more shorts, and the shareholders will benefit from an even bigger short squeeze. I don't know. That's like, I'm trying to game theory it, but I really don't know. All I know is that he's been pretty consistent about trying to do the right thing for shareholders. So as disappointing as negative EPS was, and it didn't even it was disappointing EPS at that. It wasn't even, they didn't even come in where the expectations were. The expectations were like negative 50 cents or something. I can't remember. But it ended up coming in at like -8 or something. It was ridiculous. So not only was it not amazing, but it was disappointing. So we probably should have had a bigger sell-off than we already have. It's only down 20% or whatever, 16%. So that's the MicroStrategy update. Nothing has changed long term about what I think about the stock, and I think I picked up another 25 shares today or something on the dip. For some reason, well, I know, not for some reason, I know the reason, but I ended up getting some kind of upgrade on my margin account, so I had a little more buying power this morning when I woke up than I did yesterday. I actually contacted customer support because I'm like, is this a mistake? Because if it's not, I'm going to start spending some of this buying power. So picked up some more MicroStrategy today on the dip. And I did add in 2 more covered calls. I picked up the 1400 strike when the price was 1200. So I baked 20% in there in case there's a rally, 20% call away. And then when the price had dropped down to like 1100, I went ahead and added this covered call. Picked up 450 on this one, 490 on this one, and I baked in 20% on this one as well. But the price had fallen by then, and so I did not put another covered call on the third 100 shares. I could, but I really want some uncovered shares. I've still got PTSD from a few weeks ago when MicroStrategy doubled and then tripled, and it just blew through my strikes and cost me quite a bit. So still a little shell shocked from that. So I'm just being super cautious, and it annoys me because I'm kind of letting this now It's making me trade a little scared, which I don't like. I usually trade very mechanically, and if the price goes up, I don't care, and if the price goes down, I don't care. But all the MicroStrategy hype just got me so excited, and so now with that, being on a little bit of a, the buzz is worn off, and now it's just a little bit of post earnings hangover. I'm just a little nervous about a rally that goes to 15 or 1600 or something, and then I've limited my upside too much. So for now, I'm leaving these shares uncapped, and if I can get, well, on Friday when I have a full week of premium to collect, maybe I'll wade back in on all three, and if I can sell each of the covered calls and get 2-3% premium on each one, then that would give me some more buying power to add some more shares, and I'll end up with might end up with 10 shares, 310. So that would make me feel a little bit better. Or else I could even buy back some more of the Tesla leaps that I sold to be able to afford the extra shares of MicroStrategy in the first place. I think my Tesla holdings are now is only 5% of my buying power. So I don't like that. It's a little way too lopsided, I think. But either way, all right. So that's the MicroStrategy update, and I'll quickly go over. I don't know how quick it's going to be. I'll go over the SunQuest. Sorry, I used to work on that software. Square. Is it called Block now? I thought this was Square. Anyway, by request, this was. I guess they have earnings on Thursday, and the other one is Coinbase. And so usually I have a watch list for earnings, and Tasty Trade has a nice little liquidity stars here. Generally, I won't even trade something below 3 stars, except MicroStrategy is too valuable for me to not trade, and it's only 1 star. And when this is trading at 1 star, the options is even worse. It's even harder to get fills. So the fact that SQ and Coin are at 3 stars is good news. Now let's confirm that, because that's just ballparking. So let's check bid-ask spread, nickel apart, tons of interest and volume. Yeah, so this is tradable. Let's check Coin. Bid-ask. This is not as good. The $2 bid-ask spread here. That's not a fluke. Let me check the 200. $1.50. So Coin would be a little bit harder to trade. Options, it's going to be harder to. I mean, there's tons of open interest here, so it's not going to be that hard to get a fill. But I still don't like it. There's a little bit of friction getting in, and then a little bit more friction getting out of this trade. But it seems like the interest in these two stocks were because they also hold Bitcoin and could decide to report with the FASB rules. So maybe some of that MicroStrategy excitement is rubbing off on some of these other Bitcoin derivative type stocks. I used to trade Coin quite a bit. I'm not sure. I probably did trade SQ. But as I had said before, if you buy calls or buy puts before earnings, you're putting yourself at risk for IV crush. So I never prescribe what others should do, but as a rule, I don't do it, because you're fighting implied volatility And I went ahead and loaded up SQ here. This is actually a pretty good earnings crush chart. So you see implied volatility building, and then it collapses. This one's not a great example, but it does still collapse. IV's building, collapse. IV's building, collapse. Looks like IV's building. So if it continues with the pattern, I would expect for implied volatility to drop from whatever this is, 70 almost, to 40. So if I'm just going to, let's just say at the money, I'll look at the buy. So if implied volatility drops by 30, and these things are being measured in different ways. So this is the implied volatility of this option, whereas this implied volatility number is the IV30. So this is the average, this is the running 30-day implied volatility. It's been a while since I really traded earnings. Historical 30-day IV, yeah. So this is a slightly different measurement of implied volatility on Market Chameleon than Robinhood is representing for the option. So this is for the stock. Implied volatility for the stock, and this one is going to have an implied volatility for each leg. Each leg is going to have a little bit different implied vol. But let's just imagine we get a 30-point drop in implied volatility, multiply that times Vega, that's 30 times 0.02, so that's 60.6. So if SQ stays at 72.80, if it closes the day before earnings and then the market opens and it's still 72.80, there's no reaction whatsoever, the value of this option should drop by 60 cents. So you would need the price to go up to 73 to recover that, because the delta is going to get you 56 cents for every dollar move. So you'd need 73.80 to pretty much make up for that loss. Which is, I mean, I'm an option seller to begin with. I basically just sell covered calls. I used to run the wheel, so sell cash secured puts until you get assigned, then sell covered calls until they get called away, and then rinse and repeat. I basically just do the covered call, selling the covered call half of the wheel. Basically works out to amount the same thing, but some people like the wheel and just, I don't know if it's a little bit of variety or whatever. Works out to about the same thing as far as I'm concerned. So what would I do if I was actually going to trade this? So if option buying is off the table, then the only thing left is selling. You're going to sell calls or you're going to sell puts. And so what I would probably do is I would go down to around the 80 to 84%. These are probably going to be roughly, the deltas match fairly close. So this is, Robinhood is telling you this is an 80% chance of profit, which usually matches up to the delta. There's like, the delta, this is 0.19, let's just say it's 0.2. They're basically saying that there's an 80% chance that the price of block will stay above 65, and there's a 20% chance that block will go below 65. These are just models, these are just predictions, so they're inherently flawed. And that's kind of one reason why I think it's possible to even make money off of these strategies. And implied volatility is considered a mean reverting statistic. So you can see where it kind of like, okay, this is its normal, its average implied volatility is going to be somewhere between 36 and 80. So just add those up. We're going to say 110, 120. So 55-ish is probably the average implied volatility. It's going to go below it, and then it's going to go above it, and it's going to go below it, and go above it. And it just keeps reverting to the mean. I've never seen an implied volatility chart where it just is at 100 forever, or just stays down at 35 forever and just a straight line across. Not to saying that it's not possible, but in general, people talk about this as being a mean reverting statistics, you know, up and down, up and down, up and down, up and down. And so if you're going to lose money by buying options before earnings, it makes sense that if something is going to become less valuable, then you sell it the day before, and then you can buy it back cheaper. So I would sell like the 65. So you're gonna have to put up $6,500 as a cash secured put. Collect $1.20 in premium, and then if implied volatility collapses, then collect however much. So if implied volatility drops by 30, that would be 30 times 0.1, which would be 3. Is that right? 0.01? No, 0.3, excuse me. So this could drop from $1.20 to 90 cents just from Ivy Crush alone. And then you just buy it back for 90 bucks and you pocket the $30. Now that doesn't sound like much because you put 6,500 at risk. 1% of 65 would be, 6.5. So you're really only collecting like 0.5%, but that's a one-day trade. You're going to put this, and not even one day really. Usually you wait about 15 minutes for the market to kind of settle and then close these out. So you're really leaving this trade on for like 30 minutes. You'd sell this right before the close, earnings happen, and then you buy it back, right, 15 minutes after the open. So this is like a 30-minute trade. And you'd want to do it in a stock, really, that you wouldn't mind owning. I mean, you can just, if the price goes against you and the price goes down to 60 and you don't want to own this stock, then you can just close it and take the loss. But the half of the wheel is the cash secured put, meaning if you thought, you know what, I don't mind owning block, and then if I get assigned at 65, I'm getting a $7 discount off the price. And then for next week, you can just sell a covered call and collect, whatever, build 5 to 10% call away value into this. 10% would be 7, so 350, 76. Collect $200 a week on this until the price goes over your strike, and then you just let it get called away. You can do that. The other part of this would be, on some exchanges, they'll actually let you sell naked calls. And so Tasty Trade's got a shitload of videos. They sell strangles. They're perfectly comfortable with unlimited risk. I am not, so I never sell naked calls. But so they would do a strangle. So they'd sell a put like at the 65, and then they'd sell a call, same thing, go up to like 84%, and they'd sell a call here. And you can see the little chart. You make the most of your green money here as long as SQ stays in between 65 and 83, and then you lose money, unlimited amounts of money potentially if it goes up there. So if I was going to do this and I wanted defined risk trade, I would sell the 65, and then I would buy, to make sure that this is still ends up being a sell, you have to buy the cheaper one. So if I only wanted to risk $100, I would choose $1 width of the strikes. So this is a put credit spread, and you would only get credited with $27, but instead of having to put up $6,500 as a cash secured put, you only got to put up the $100. And if you are not directional at all, you could actually turn this into an iron condor by adding a call credit spread. So what did I say? I was going to sell the 82 and then sell the more expensive one, buy the less expensive one. And Robinhood knows that this is an iron condor that we just set up. And again, the graph shows you that if the price stays between 65 and 82, that's when you make money. If the price goes above 82 or below 65, that's when you lose your money. But you're collecting a credit on the credit spread, the put credit spread and the call credit spread, but you can still only lose, your max loss is still $100. Wait, there's a 200. Let me see. Yeah, max loss $50. Yeah, because you're getting paid 50. Your max loss is really 100, but you got paid 48 up front. Yeah, it's been a while since I did these. So yeah, I mean, I did tons of these, and let's just hit continue. It's after hours, so it really doesn't matter anyway. But this is the problem. So when you start making these large credit spreads, the bid-ask spread now is like 27 cents, and the premium is only 50 cents. So even though this has decent liquidity, not sure how well this would work. I mean, look, if I just do the put credit spread, yeah, still it's a 16-second bid-ask spread. Don't really like it. But if I was determined and I thought, okay, maybe the price will go up, then I would either just sell a cash secured put if I didn't mind owning the shares, and I would just sell the 65, or if I only wanted to risk $100, then I would put this put credit spread together, sell something around the 80 to 84% chance of profit, and you can, definitely don't try this for the first time based on this one video. I watched hundreds of hours probably of taste to trade videos before I did anything like this, but you can widen the strikes too. So if you make this 5 wide, now you're risking $500. And I used to actually plug this into the what's the gambling formula? It's escaping me right now. But just to make sure that I kept my trade sizes properly and didn't get a little too big for my britches and can't lose too much in one trade. But in this scenario, you're collecting 89 cents premium, but you are risking $500 because the strikes are $5 apart. Now, the cool thing about the Iron Condor, though, is, let me set it up again, and I'll make this one 5 wide as well. And it was the same way with 1 wide. But the reason why you're collecting twice as much premium, but you're still only putting Like each one of these is 5 wide, but you're not putting up 1,000. Your max loss isn't 1,000. Your max loss is still 500 minus the premium that you collected. And the reason is because if this goes above 88, sure, you lose this side of the trade, but you won this side of the trade. You got max profit over here. So with the Iron Condor, both of your legs could win. If it stays here, both legs win. Both wings, excuse me, of the Iron Condor win. But if you go above, this wing loses, but this wing is a winner. So that's why you can only ever lose the width of one of your strikes, because one wing has to win. So that's kind of cool with Iron Condors. Yeah, so that's as an options seller, I pretty much try to only sell options under any conditions, but definitely around earnings, buying options is in general a bad idea. I guess maybe if you got some insider trading knowledge, then, you know, go for it, but I will not be participating. So coin would be similar. If I was going to sell a cash secured put, I would go down to around, let's do like the 80%. Sell a put, you're going to collect $335, but you're going to have to put up $18,000 in cash in order to sell this put. Is that right? Yep. Max loss, 18,000. You know, if the price of coin went to zero, that is. But there's an 80% chance that it'll stay above 180. And again, let's just look and see. Oh, let's take a look at coin. This is Market Chameleon. So coin 90 collapses to 77. 78 collapses to 65. Now this is the IV30 though. So let's just say if it's collapsing 10% and we lose 10% of this, that's like 17. Let's just say 20. So if we lose 20 implied volatility times 0.04, that's, was that 0.8? So you could stand to buy this back for $250 tomorrow or something. And if the direction goes the way that you want, I mean, you can collect more, but it's just a quick hit. I mean, you're only obligating this buying power for about 30 minutes. But if coin is something that you wanted to own, and you're like, you know what, if the price goes down from 200 to 180, and you like getting a 10% discount on those shares, and then next week you can just turn around and sell a covered call and collect another $1,000. I mean, if the price collapsed to 180, you wouldn't be able to collect quite this much, but maybe, I don't know, $500-600. Even if it's only, if you bought them for 180, 1% would be $1.80. So even if you're only getting 200 a week in covered call premium, that's still 1% a week, which is 50% ROI for the year. Same thing, if I was going to sell a put credit spread, go down here, so I'm selling this put, go and buy the cheaper one. You could collect, yeah, see the bid-ask spread on this is 80 to $1.50. I would not make this trade. I would avoid this like the plague. The liquidity is just not there, because you could win this trade, and if you're trying to collect half of this, collect like $50, and you get screwed on 25 of those $50 because of the bid-ask spread. That really sucks. So yeah, probably would not do that. And the Iron Condor is going to be worse because the bid-ask spread on the bottom is going to be added to the bid-ask spread on the top wing. I no longer own anything but MicroStrategy, Tesla, Bitcoin, and some mining stocks. But I used to trade the hell out of coin. I used to own a good amount of it. So if it's something that you wanted to own, then you could absolutely sell any of these puts, really. Because if you sell the 200, you're getting paid 10, which puts your cost basis to 190 already. So if you wanted to own coin, you could just sell this put. And then here's the thing though, so you sell this put, if the price does go to 250, the max you can profit off this is $1,000. When you get paid premium selling options, whatever you got paid is the most you can make. See, this is horizontal. You're not going to make anything more if the price goes up. Now, the alternative to screwing around with options is just to buy shares of it. If you buy shares, you can ignore all these Greeks because the delta on one share is just one. So there's no options decay, there's no IV crush, none of that stuff. But that's just speculation. If you want to speculate and you think these guys will report fair market value on their Bitcoin holdings and surprise the market and everything will go up, I guess you could do that. But I'm not really excited about any of these other Bitcoin derivatives. It's basically MicroStrategy for me. And I do trade a little bit of the mining stocks. I trade a little bit with my son every Friday. And as a broke college student, he can't really afford much more than 100 shares of mining stock. And so that's kind of just for fun. And I also have, this is my kind of like my small trading account. I did a 5K challenge, and I've within a few weeks turned 5K into 3,700. So maybe you shouldn't listen to me. Not really a big deal. The down plan is the same as the up plan. So I will continue to sell covered calls, as you can see, every week, and then reinvest the profits into MicroStrategy, which I'm excited about because since Tesla pumped, I sold a bunch of these leaps and I had 10 of them. I think I sold 9. I just kept one around kind of for sentimental purposes. And so that freed up some good buying power. And I bought like just enough MicroStrategy. Yeah, so I sold 1 at 147. I sold 2 at 134, 2 at 122. There's a few more sells in here too. But I was happy that freed up some buying power. And I bought just enough MicroStrategy to get to 1 share. I think I have like 1.00007 shares. So excited about that. I haven't DCA'd this enough to. This is still down like $500. So looking forward to the next pump, and no guarantees it'll be tomorrow or the next day, but I've basically settled on MicroStrategy and Tesla as my 2 kind of trading pairs. So it was nice that Tesla pumped and I could buy some relatively cheap MicroStrategy. And then if MicroStrategy pumps, maybe I'll add in a couple more Tesla. And if Tesla's already pumped, I will probably, especially with the way that they're calculating margin in this account, maybe I should just do it now while this is kind of pumped Yeah, maybe on Friday, if Tesla's pumped, I'll just sell these leaps for whatever I can get, and then I'll just buy 100 shares of Tesla, and then I'll sell covered calls against that. The leaps made sense before they gave me some extra margin. They changed the margin rules in this account, and I basically can trade my stock at the same rate as options, so it just makes more buying power available. All right, I hope that answers the questions that were that they had about. I keep wanting to call it Square. I guess Square was SQ Square, and now it's blocked. But and just a quick note, you'll notice that nothing that I talked about was like fundamentals. I don't do technical analysis. I don't really do a lot of company research. So I did enough, and even the research that I've done to conclude that I want to invest in MicroStrategy is just because I believe in Bitcoin, and I believe that MicroStrategy is best positioned to manipulate buying the most Bitcoin. So I don't know jack shit about their development team, their business software, their AI development, none of that stuff, and I kind of don't care. I am bullish on Bitcoin because I call this series the Orange Pill Investor for a reason. I'm convinced that the world will be changed for the better by Bitcoin. I just want to live long enough to see how it looks and be able to experience it. And so I believe in MicroStrategy because I believe in Bitcoin, and I believe MicroStrategy is positioned to accumulate on credit, cheap credit, as much Bitcoin as humanly possible. So that's why I own it. That's why I'm interested in it. And that's why, even though earnings was a disappointment, nothing about my trading philosophy or my diamond hands philosophy has changed. And actually, you know what? I was gonna, maybe I'll do another video later. I'm gonna do another video. This one's gone on too long. I'm gonna do another video on when to sell Bitcoin, and I know the answer is never, but just as a thought experiment, when will I think about trimming some MicroStrategy? When would I think about when it makes logical sense to trim Bitcoin and risk the tax hit or whatever? But anyway, I'll save that one for another day. But I would definitely think about trimming some MicroStrategy if it pumps to like 10K, 20K, something ridiculous like that, and then buy some Bitcoin with it. Because if Bitcoin goes into another bear cycle, then Bitcoin would probably not collapse as much as MicroStrategy would. And Bitcoin can easily collapse 50 to 75% off all-time highs from cycle to cycle. So imagine having $10,000 MicroStrategy and watching it crash to 5. That would be heartbreaking. I know a lot of us in the community will be diamond handsing every share, but if Bitcoin is up triple and MicroStrategy is up 10x, I would absolutely scalp some MicroStrategy off the top, and then add to my cold storage, my Bitcoin in cold storage. Anyway, that's just me throwing that around. I don't have a solid plan for that yet, but I think I still have another year and a half to figure that out exactly what I want to do. So to recap, buying options before earnings is probably a terrible idea, and selling options could I'm not promising jack shit, but could take advantage of IV crush. If IV's high and it drops, you could sell the option the day before, buy it back cheaper the next day. You know, there's 350 trading days? No, I'm sorry, 250 trading days a year. If you make 0.5%, you know, like this doesn't sound like much. Selling a put here and maybe collecting 0.5%, but that's in one day. And if you can get 0.5% every day for 250 trading days, it's 125% ROI for the year. So that's another reason why I like it. It's like aggregating tiny profits, just little bits at, little chunks at a time, and especially if it's a company that you don't mind owning long term. If you're like, hey, I'd like to own some SQ, then you don't even have to worry about closing this. If it goes below your strike, you can just take the discount. You can get your $65 SQ that was 72 the day before. But the price might be 60, so you still might end up paying 65, and the stock's only worth 60. And there's no guarantees in the stock market, so. I'm always going to be an option seller. I kind of feel like if I was a carpenter, like my dear old dad, selling options is what I keep in my tool belt. That's the stuff that I use every day, all the time. And then buying options is like special occasions. Maybe try to keep those in the toolbox. A little too heavy to carry around, lug around with you all day. But go and break into it and bust out those other tools if it makes sense to do so. I know the momentum traders do it, so if you can figure that out, good on you. I may tackle that next and see especially if I can quit my 9 to 5 and I can just sit here and look at the market all day. Selling covered calls, I only do weeklies on Friday, so it only takes 30 minutes to do a whole week's worth of work, basically selling weekly covered calls. So if I got nothing else to do the other 39.5 hours a week, then maybe I could learn some momentum trading and whatnot, which is actually why I have, nope, I thought I had the 52-week, yeah, is this it? Yeah, 52-week highs. I shouldn't even talk about it, but I've already started. So, but basically, when something's hitting a 52-week high, it starts to get a little feverish, and if you can catch that momentum, you could get in and out of a trade. Buy a call and then sell it back for more if you do it before the momentum wears off, before the fervor wears off. But I definitely don't have any advice on that. I've only dabbled in it, and that's why I settled on selling covered calls. It's kind of easy mode. You just own shares, sell covered calls against it, collect the premium, use the premium to buy more shares, and go even longer. So that's my strategy, and I don't see myself giving it up anytime soon. It's been working. So I know I tried to end the video like 10 freaking minutes ago. All right, be good, y'all.